welcome to the latest market update for the month of November with me, Andrew Dawkins from A.R.D. Consultancy. So November was going really well for us until the last week in the month when we got the new variant of COVID-19. This caused markets throughout the world to panic yet again and resulted in a lot of the gains for the month being wiped off. However, most of the portfolios, apart from one, ended the month on a positive fashion. The big winners. Well, this month we saw the US fund doing particularly well, up 3.5%. Back of some good reporting numbers from American companies. Again, got some major challenges with supply and demand outstripping supply, labour shortages and inflation. The big news was that Joe Biden managed to get the stimulus package through, and this will now start rolling out in terms of giving the economy there a boost from the financial stimulus. The Federal Reserve is considering reducing the amount of support it's providing, especially with inflation being fairly high and not being reduced quite as quickly as the chairman might originally have thought. But nonetheless, the US remains the world's largest economy by a huge mile, and very impressive figures for them. Asia did very well for us this month with a gain of 2.3% over our funds, and this was picked up by some good numbers coming out of Japanese in particular companies. Demand is still very, very high. There's a lot of consumer confidence there, but again, the market's sort of dominated by COVID and the effects of lockdown, which continue for many parts of the continent. The big winner for this month was, again, for the second month running, UK gilts, with our gilt fund up over 5% over the month. The back of inflation pressures and the Bank of England perhaps looking to increase interest rates all led to gilt rates increasing for us. So a very, very good month for gilt on the back of 18 months of very, very depressing returns. So gilt's up second time in a row. They're the winner. So that's very, very good there. Equally, global debt, so emerging markets and also major economies, the global debt funds that we hold up 2% over the month, and again on the back of inflation concerns and perhaps interest rates rising worldwide. Property also had another good month, and perhaps a good reason for property prices being up was the fact that a lot of the property fund is measured in US dollars, and the dollar's had a very, very good run over the last few months, and indeed it's probably set fair for the next wee while as the period of uncertainty continues. Europe was a steady Eddy this month with positive growth of 1%. Unemployment figures throughout Europe generally are at a very low point. Normally we would expect the month of November employment figures start to reduce, and they pick up again in December when people start taking on seasonal work again. But actually for most of the countries, unemployment levels are at pre-COVID levels, which are very, very good. Pity the people though in Bosnia, where the unemployment rate for October stood at 31% of the working population. The losers this month, well, the loser probably was the UK equity funds, and the UK equity funds that we advise on down approximately 2.8% over the month. Supply chain issues still account for major challenges here. Labour shortages, inflation is probably actually a good thing for us because it shows again that there's more demand than supply, and that's good short term for a lot of the companies and the assets that we hold, especially if those companies can pass on increased prices to the people next on the supply chain. So in summary, although November generally was depressed because of the latest COVID-19 variant, generally there's cause for optimism. A lot of good numbers coming out of many of the assets that we hold. Consumer confidence high in many areas. Demand is definitely there. Supply chain issues, they'll eventually get fixed as the order of the world gets restored and we get more people in those sectors that we need skilled workers within. And inflation is a worry long term, because then you get a vicious trend of prices increasing, wages increase. The worst result would be if prices increased and wages didn't, and then that's not so good for anybody. But generally, short-term inflation is actually quite a good friend of ours. And in terms of the outlook, then we're going to get the volatility continuing for the next wee while. We've also got political pressures throughout the world, especially in China, Russia, and other parts of the world which do play a part. But these are part and parcel of a normal economic cycle and have to be expected. Underlying, though, the funds remain very, very well placed, and the volatility that we're seeing at the moment is good news for us long term, because this is where the profits of the future are made. When the price reduces sharply, the fund managers are able to use their excess capital to purchase assets at a cheaper price than would have been available normally. So volatility is good. The underlying performance of the funds has been exceptional this year, and we remain very, very confident that the next year or 5 are going to be superb for making money in a measured way. So continue to be invested, and we wish you a very, very good Christmas and a Happy New Year.
And now we will take a look at A.R.D. Consultancy's portfolios and their performance over the past month, year, 5 years and 10 years. We'll start with our defensive portfolio. 1 month, it is up 0.4%. 1 year, 4.8%. 5 years, 29%. And finally 10 years, 82%. Our cautious portfolio for the month is up 0.3%. 1 year, 8.6%. 5 years, 39%. And 10 years, 112%. Our balanced portfolio for the month is up 0.1%. 1 year is 12.5%. 5 years is 54%. And 10 years, 153%. Our capital growth portfolio for the month is 0%. 1 year, it's up 16.7%. 5 years, 68%. And 10 years, 206%. And lastly, our aggressive portfolio for the month is down 0.1%. For 1 year, we're up 20%. 5 years is 84%. And finally, 10 years, up 277%.